market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards, live from Bloomberg's inaugural Women, Money and Power event in London. In for Francine Lacqua this hour, here are your top stories. European stocks slip after China's rally fades, damping earlier enthusiasm about a stimulus boost in the world's second largest economy. Police charge Luigi Mangione with murder for the fatal shooting of UnitedHealth executive Brian Thompson, the 26-year-old arrested in Pennsylvania after a 5-day manhunt. Plus, we'll hear more from some of the most influential voices in finance from around the world here at Bloomberg's Women, Money and Power event. Welcome to the program, everybody. Let me tell you that a top live blog, TLIV blog is now running on the Bloomberg terminal. That is open to Bloomberg subscribers, of course. It'll cover everything you need to know about the event. You can check it out on the terminal using that function, TLIV Go. We are also going to be hosting later on a live Q&A about the event with some of the fantastic internal voices who'll be covering the event. We'll have crypto covered, M&A covered, the world of finance from top to bottom covered. That Q&A from 1 p.m. London time, so you can log on to that and ask questions of our panelists. Let's take a look at the European markets map then and show you what we have underway as we are live from this event. We are, of course, bringing you normal service, keeping across the live market environment. And the FTSE 100 down by 0.5%, the STOXX 600 down by 0.3%, the CAC 40 down by 0.6%. So a little bit of weakness coming through on some of these markets across Europe. Let's just get to a look at the broader market picture. And we've got US futures that have been pretty negative through this morning, only just actually, and they still are just down 0.1%. So E-minis down 0.1% this morning. The US 10-year yield you can see on your screen, 4.20 is where we trade. So yields just ticking up a little bit. And we saw that at the start of the European session, a little bit of movement in the bond markets as well. In terms of euro dollar, you can see on your screen where we are on euro dollar right now, a little on the back foot, down by 0.2%. We're waiting for the ECB rate decision. That's the big central bank event of the next 24 hours, certainly. And we're waiting for CPI out of the United States. So both of those elements could move euro dollar, of course. And we'll also keep an eye on commodities. Let us turn our attention to the latest developments out of China. President Xi Jinping says that China has full confidence in achieving its economic growth target this year. His comments come after Beijing's top leaders signaled bolder economic support next year ahead of Donald Trump's return to the White House. For more, let's bring in Bloomberg's Katia Dmitrieva, who's been tracking this story from Asia for us. Katia, let's dive into some of the details then. What does this signal then about Xi's potential approach to the US come next year and potential tariffs? Because, yes, we've had these commitments around fiscal policy, monetary policy, but we've also had some commentary from Xi around trade.
Yes, well, Xi and Chinese officials are really trying to bolster the economy here, as well as sentiment ahead of 2025 and what's looking like a very challenging 2025. You know, we're still about a month away from President Donald Trump. Donald Trump becoming president of the U.S. He's promised tariffs on a raft of countries, including China. And so officials really messaging here last night, that they were going to be willing to have more fiscal stimulus and using more monetary stimulus. How the market took that was lower than expected rates and a lot more funding, potentially for households to sort of transition to that consumer-led growth model that a lot of economists have been looking for. Now, we monitor these statements because words are very important. We kind of track Chinese officials like we do the Federal Reserve. So every single word addition or removal or change signals a new direction. And this clearly signaled that officials are willing to use more of these tools to shore up the economy.
Yes, and we saw yesterday, Katia, that was something that was really pushing European stocks higher, that optimism around what China was going to deliver. We've heard a little bit more then from Xi today. It's not having quite the same impact on European stocks, but maybe all priced in yesterday. She said that the economy would hit its 5% target this year. Do economists agree with that? How much credibility do they attach to these kinds of statements?
Yeah, they absolutely. So far, they do agree. And now we're kind of at the end of the year. All the forecasts are in. And a Bloomberg survey shows that economists are expecting 4.8% growth, which is exactly in that target range of about 5% that Chinese officials set sort of earlier this year. And so they're looking to hopefully sustain that momentum into next year. But that will be very challenging, not just because of the tariffs and the fact that China has really relied on exports to drive growth this year, but also because of bigger issues, structural issues. The real estate sector still hasn't found bottom. There's still a lot of consumer sentiment that needs to be pulled up, and a range of other issues, including deflation as well. So maybe for 2024, but more of a question for 2025.
Katia, thank you very much. Bloomberg's Katia Dmitrieva with us there with analysis of the China story. So some of it priced in, as we said yesterday during the trading day, or maybe much of it, because Basic Resources went from the real darling of the trading day in Europe yesterday to somewhere near the bottom of the pack. Let's move on to some other corporate news flow that we need to cover. Oracle's quarterly revenue was in line with estimates, but shares are falling more than 8% in pre-market trading. We'll put that latest live price on your screen for you, and it is, yes, in negative territory. Let's bring in Bloomberg's Tom McKenzie, who's been covering the tech story for us from various angles. So Oracle's revenue, Tom, it was in line with estimates, and yet that doesn't seem to be good enough in today's market. Why the pre-market slump?
Yeah, look, this is an element of the earnings story when it comes to AI that you and I have discussed before, which is about expectations. Very, very high expectations, particularly given for a stock that has seen a more than 80% run-up year to date in two previous blowout quarters. This was not a blowout quarter, but do not make any mistake, this doesn't suggest, the earnings from Oracle, that demand for AI is waning substantially. But they just didn't meet the expectations that analysts had. Again, given what has been that outperformance in previous quarters. Revenues increased 9%. The unit that provides the infrastructure around the cloud business, so the data centers part of the story, which is so important when it comes to AI, that actually saw growth of about 52% for the quarter. But there was a little softness in one measure of forward bookings for the business, and also the earnings per share came in a little below the estimates as well. In terms of the guidance for the current quarter, so Q3, there's a little bit of disappointment there as well in terms of the revenues guidance and the profit guidance also missing the estimates. Larry Ellison, the co-founder, of course, of this business, the chair, he's still talking very positively about the AI prospects for Oracle going forward. He talked about a deal that they have with Meta to train some of their AI agents on Oracle's infrastructure. But clearly, this is again a question about whether analysts set their expectations and Oracle's ability to deliver. The stock, as you say, feeling a little pressure so far pre-market.
OK, and what does so there's some questions then perhaps come out of that about AI demand, and that's something that the market has been very sensitive to, and maybe why we see such movement in the Oracle share price pre-market. But what about what we've heard from other parts of the tech space on that theme, Tom? TSMC's results, for example.
Yeah, so TSMC's numbers, and these are monthly numbers, show that demand is still there. This is a company that provides the servers to those data centers, and the increase in sales for the month of November, 34% for TSMC, again, underscores the demand is still there. They, of course, make the chips as well, the GPUs for NVIDIA, the chips for Apple and others, but increasingly pushing into that AI infrastructure space as well, providing that hardware for the data center. And it suggests that TSMC is still very well positioned. Interestingly, Bloomberg Intelligence suggests that maybe TSMC will have increased pricing power as well, given the challenges that Samsung, its key rivals Samsung and Intel, have faced in terms of developing their own infrastructure service to provide that infrastructure support for this AI revolution. So TSMC is still performing quite well. The stock, by the way, in terms of that company, Taiwan, of course, listed over in Taiwan, up about 80% year to date as well. So it's been a very strong performance, and the numbers today suggest that demand is still there and TSMC is still well positioned.
Tom, thank you very much. Bloomberg's Tom McKenzie, of course, with all those tech themes, pulling together some of those AI-related stories from Oracle to TSMC. Let us keep you updated with some of the geopolitical developments that we need to cover. The rebel group that toppled President Bashar al-Assad has begun forming a transitional government, according to Syrian television. It's being led by Mohammed al-Bashir, the head of a quasi-government set up in 2017. The move comes after a meeting between al-Bashir, HTS's leader Ahmed al-Sharaa, and current Prime Minister Ghazi al-Jalali. Brazilian President Lula is in intensive care. That's after undergoing emergency brain surgery in Sao Paulo. The hospital says the craniotomy was uneventful and that President Lula is in good health, but he is being monitored. Coming up on the programme, we are live at the Women, Money and Power event brought to you by Bloomberg, our inaugural event. Francine Lacqua will be discussing global investing industry trends with Jenny Johnson, President and CEO at Franklin Templeton. We will certainly be sure to miss nothing of the main events taking place at this conference here in London. Women, Money and Power in a few minutes. This is Bloomberg. Welcome back. This is The Pulse. I'm Anna Edwards, in for Francine Lacqua. We're live from the Women, Money and Power event here in the City of London, brought to you by Bloomberg. We're waiting for things to really kick into gear here. And in the meantime, let's get up to date with another important story this morning. A suspect has been charged with the murder of UnitedHealth Group executive Brian Thompson. 26-year-old Luigi Mangione was arrested after a tip-off at a McDonald's restaurant in Pennsylvania. The state's governor, Josh Shapiro, says the suspect should be, quote, no hero to people frustrated with the American health insurance industry.
In a civil society, we are all less safe when ideologues engage in vigilante justice. In some dark corners, this killer is being hailed as a hero. Hear me on this. He is no hero.
For more, let's bring in Bloomberg's Jill Desis, who's been following the story for us. Jill, what do we know about the suspect, then, in this killing?
So, Anna, so far what we have is, the suspect's name, Luigi Mangione. He's 26. Appears he came from a very well-off family in Baltimore, Maryland, and was actually valedictorian of his high school class, went to an Ivy League university, Pennsylvania University. Still getting a lot of details right now, but it appears that when he was ultimately arrested in Pennsylvania, before these murder charges in New York actually came through, he was found with what we're hearing appeared to be some type of a manifesto that kind of rails against the healthcare industry. There's still a lot of speculation about what exactly led this to ultimately happen here. There's been various bits of speculation online as to where his political leanings ultimately led. By sort of trawling through some of his online accounts, we've learned that he actually had followed the manifesto from the Unabomber Ted Kaczynski, and had actually said that even if he disagreed with what Kaczynski had done, he had made some interesting points. So again, some of these political or at least philosophical leanings still kind of coming into play here. There's also a bit of speculation about how much maybe some kind of an injury may have played into some of his feelings and how that may have manifested in the form of this killing. If he did actually commit it. But again, all of that is still kind of coming together here. But really does sort of paint the picture of somebody that came from a very well-off background that's gotten into this kind of situation as we wait for more details here.
Yes, so certainly waiting for more details. As we were just hearing from state voices, no place in civil society for this kind of vigilante action is the view there. But of course, this does seem to have resonated, the underlying motivations, if they are what they seem to be, around an unhappiness with the healthcare system. That discrete point does seem to have resonated with a number of people, Jill.
Yeah, sorry, Anna, you're a bit hard to hear, but yes, I think that ultimately what you're seeing here in this killing is something that clearly has resonated, with a lot of Americans, certainly, also just sort of around the world a bit here. You've got this killing involving a high-profile executive CEO of United Healthcare Insurance. It's this predominant insurance company in the United States, covers many Americans on insurance, and there's something about this killing that's really sort of encapsulated a lot of the frustrations that are facing a lot of Americans who are very critical of the American healthcare system, because even when you're putting in these incredibly high premiums toward your insurance coverage, often certain surgeries don't actually go covered. And we've really seen over the past week since this killing took place, a lot of, this kind of frustration manifests itself in the form of, statements online, people talking about some of their insurance stories, that kind of thing. So it has been, really, really interesting to kind of watch this unfold, not just as a story of the murder of this man, but also something that just sort of, turned into this broader sort of critical view of the healthcare system. I think it'll be really interesting to watch how that goes forward. Obviously, some details that are still developing here, not just about the suspect, this person of interest involved in this killing, that police are alleging to be involved in this killing, but also what it says about this industry at large.
Jill, thank you very much. Bloomberg's Jill Desis joining us there with the latest on the hunt for and the seeming charging of that suspect. Let's get to some other corporate news that we need to cover for you. Stellantis and China's CATL are planning to invest as much as 4.1 billion euros to build a new plant in Spain for electric vehicle batteries. The facility could reach a 50 gigawatt-hour capacity, depending on the EV market in Europe, and continued support from Spanish and European Union authorities. Meanwhile, Bloomberg understands Italy is in talks with Stellantis about commitments to protect jobs and support suppliers. This as Chairman John Elkann seeks a new course for the maker of Fiat and Alfa Romeo cars that recently ousted its boss. Shares of the chocolate maker Hershey surged after Bloomberg reported that its bigger rival, Mondelez, is looking to buy the business. A potential deal would create one of the world's biggest candy companies with combined sales of almost $50 billion. Sources say Mondelez has made a preliminary approach to Hershey, which has a value of more than $44 billion, including debt. China has opened an investigation into Nvidia after suspicions that the US chipmaker broke anti-monopoly laws around a 2020 deal. Beijing had given approval for the deal 4 years ago on condition that Nvidia did not discriminate against Chinese companies. The move is being seen as Beijing's latest response to escalating US technology curbs, as a feature of those curbs may be to discriminate against Chinese companies. OpenAI has rolled out its long-awaited Sora AI video generator to paid users of ChatGPT. The tool creates realistic-looking videos up to 20 seconds long using just a few text prompts. Users on cheaper ChatGPT subscriptions will be limited to creating 50 videos a month. The service isn't available in most of Europe, which has tougher tech regulations. Now we are at the Women, Money and Power event. The global investing industry has undergone dramatic shifts in recent years, with firms getting bigger, passive funds catching active ones, and the rise of private capital. Bloomberg's Francine Lacqua will be discussing all of these challenges with Jenny Johnson, President and CEO of Franklin Templeton, here at the Women, Money and Power event. Let's listen in.
Banks really want to preserve their capital for their biggest and best clients, and so it created this opportunity for private credit to step in. I think that, honestly, low interest rates were probably one of the things that fueled private equity, but also a bit of the environment where I think less and less companies want to go public, and I don't think that trend changes. I don't think there's a lot of people going, boy, I'd really like to be a public company CEO these days. And I think in a time where you have all these great technological advances like AI, where companies need to invest in the technology that may not pay off for years, it's really hard with the pressure of quarterly earnings. And so in some cases, transforming a company ends up being better in the structure of private equity. So I think like that trend is here. I think, look, I'm a big fan of blockchain. I think that's going to open up new investment opportunities and kind of interesting things. I always say that eventually your financial advisor is going to report your portfolio in 3 ways. They're going to say, here's your investment return, here's the impact you have, and by the way, here are the loyalty programs that you've gotten from your tokenized equity ownership that have now tied loyalty programs to it. So that's where I think things ultimately evolve.
So on blockchain and Bitcoin, does that change significantly under a Trump administration?
Oh, for sure. And again, I always make sure you separate Bitcoin from blockchain. Okay, so
fair.
Bitcoin, different deal. I was a skeptic of it initially, but a couple things people said to me. One, somebody who lived in Israel said, my parents and grandparents had their money taken away by the government. They will always keep a portion of their savings in Bitcoin. And then I had actually an employee who lived in the Middle East and said, if I say the wrong thing, I can have my accounts frozen. So I always keep a percentage of my earnings in Bitcoin. And obviously in the kind of key, because they can keep it protected. So if you grow up in a society where you feel your money's safe, you think that doesn't make any sense. And why should this external currency come in? But if you actually think that there's a lot of the world that would like that safety and control, you can see where Bitcoin has a lot of opportunity. And then blockchain, again, it's a technology. It's a technology that's going to do a lot of really good things in financial services. A lot of toll takers take a piece of a transaction. That can eliminate it. And so it's going to create more efficiencies. It's going to open up investment opportunities.
Jenny, do you think that there'll be a catalyst for companies to want to go public again, or is it just private all the way? Is this, a trend for the next 5-10 years?
So I actually think it used to be you go venture, private equity, IPO, public markets. I think that stays, and we see it where people are just waiting a lot longer to go public. But at some point, people want that liquidity and monetize it, and the private markets aren't yet that liquid. There's some amount. But I actually think what you're starting to see is public companies being taken private because we invested in a company, InvestNet, and they have $3 trillion in assets by financial advisor platform, right? They need to invest in it. It is hard as a public company to make those kind of investments and say to the street, hey, by the way, this is going to impact earnings for the next 18 months. So they become private, right? And so they were taken private by Bain Capital, and then they'll go public, I think, again. So I think there's going to be this new cycle of pulling people off, doing the investment that needs to happen, whether it's AI investments or whatever, and then going public again.
But do you have a concern on valuations in private markets? I mean, this comes over and over again, but we haven't really seen anything. Maybe real estate went a bit ugly, but there's nothing huge.
Yeah, I mean, one of the concerns, investment grade and even some non-investment grade of private credit is trading at the same spreads as traditional fixed income. Like, so you get no premium for illiquidity. That worries me. That kind of thing, I think. Fixed income markets are priced for perfection at the moment. So, you always have to pick your spots. We have a huge secondaries business. I think that they've deployed this current fund with about a 26% average discount. There's about 70% deployed. And, what I say is it's not that the valuations are wrong of the private equity. It's that there's not a lot of supply to create liquidity in that market because there's not a lot of secondaries. But that gives you a little bit of a pricing element.
So what does that mean that you'll do for actually Franklin Templeton in terms of risk taking and does that, to take advantage of these new trends, do you change the company at the margins? Well,
we had to, right? So we've done 10 acquisitions in the last 5 years, and those acquisitions have been focused on really capabilities that we didn't have. I mean, our job is to provide our clients with choice across the full risk spectrum, and then deliver it in different vehicles, which are appropriate to whatever the client's looking for. And so we recognize that, look, this alternatives trend isn't going away. You see more and more institutions, and right now we're really nascent as far as the wealth channel, the average person's access to that. But you could see that trend, and you could see the excess returns in there. By the better players. I mean, there's a big dispersion in the top performer and the bottom performers in the alternatives. And so we recognize, so today we're a top 10 alternatives manager. So that was, most people think of us as really just traditional, equity and fixed income, but we're actually quite large in the alternatives. So it's, again, about creating choice. We also filled in some other product gaps that we had. And then now it's going to be about delivering those capabilities appropriately to clients. And so if you look at today with the wealth channel only having about 5% allocation to alternatives, that number, you talk to big distributors, I think that number is probably closer to 15%, which will mean some clients will be 0 and some will be 30. But as it's 15%, what's the best way to deliver it? Well, if you have a lot of money, if you're a high net worth, that might be in direct investments in those alternatives. But it also might be a managed account with a sleeve or a portion of that mutual fund or UCITS fund that has an allocation to the alternatives, right? And that way it creates a certain amount of liquidity that's important for a lot of people.
I mean, do all these changes change the fee structure?
So, look, the biggest probably pressure on the fee structure on the traditional markets was, of course, passive, right? I think in the alternatives, it's really important to understand the best top-performing private equity managers, top quartile, outperform bottom quartile by 20% a year. Okay, top quartile versus bottom in real estate was 10% a year about, and private credit was 5% a year. The top quartile performers are oversubscribed, and so they're not feeling any fee pressure, right? It's about people continuing to make sure they can come up with liquidity. It's why there's a secondary business, because if there's a call for that top manager to start a new fund, you don't want to be left out. My worry is who's on sale. It's the bottom, who's going to have the fee pressure? It's the bottom quartile performing. And we have trained so many people to think only about fees that as we start to introduce alternatives and things like into retirement programs, and if it's just fees, the lower performing guys are going to be the ones who cut their fees, and you're better off being in the public markets than you are to be in a poor performing alternatives manager.
Jenny, I also want to ask you about outflows. So you have been in a tough spot because of WAMCO. I mean, what happened?
Well, there's never much upside to talking about a government investigation publicly. So, look, it's a difficult situation. It was one person, and we're cooperating with the government on it. I think the most important thing is we still have a lot of clients invested in Western Asset Management, and so we have made sure that we insulated the investment team from a lot of what's going on with the investigation so that we can ensure that they're managing clients' money and staying focused on that. And so that's been, what has been important for us to do.
Will you fold it closer into the business?
So our model has always been, and I think all the way back to when Franklin acquired Templeton, was, look, if you're in the asset management business, what are you buying when you acquire a company? You're buying people in their investment process. So don't destroy value by suddenly going in and messing with it. So we leave the investment team to be very much independent, and then we take things like the fund administration, some of the client service, and we tend to bring those things in, technology and those things. In the case of Western, the other thing you can't do in the asset management business is do a hostile takeover, because people can walk out the door, right? It's not like a lot of other types of businesses. And so in that, they negotiated a 5-year standalone. So they really have run independently as a company. And so we are now in the process of looking, what does it make sense to bring in? We've hired compliance folks to take a look at and obviously continue to enhance the policies and procedures within there. We also, of course, took a look more broadly at all the rest of Franklin's investment teams to ensure that we're confident with all the policies and procedures. And, the answer is we do what makes good common sense with each. So they're all slightly different. We usually let the CIO define a bit of what that is. And I go back to Mutual Series today has the traders sitting on the desk. Templeton says, I prefer to use the global trading platform. So it's what makes sense for that investment team.
I mean, how do you find the right acquisition? Was it a tough, you have been one of the most acquisitive.
Yeah. So I would say it's kind of the 3 C's. Look, investment bankers will tell you why it's a great price and a great strategic fit, but they'll never talk about the culture and the people. And that is what determines whether a deal makes it or not. And so the thing that we look for culture, I say it's the 3 C's. How quickly, when you're talking to the team, do they talk about clients, right? Some pretty important clients. Do they collaborate with each other? Do they actually seem to like each other? And you can see a lot of dynamics on that. And then the third, do they have a mindset of continuous improvement, right? And especially a time like now with all the technological innovation that's going on, if you don't have a mindset of saying, how should we be thinking? I mean, how should an investment team think about AI? I don't know that nobody has the answer, but if you are not thinking about it, you're going to be left behind. And so do they have that mindset?
How are you thinking about AI?
So, listen,
Did I pass the test?
I hate to tell you, but I love Perplexity, and all the media guys hate it because it's look. I can't remember the last time I Googled something. I go to the either ChatGPT, Claude, or Perplexity. I force myself to use it because you have to use it. Usually what happens with technological innovation is the first thing that people do is they make more efficient what they do today, because that's all we can imagine is what we do today. But as you start to get better at the tool, and so we rolled out Microsoft Copilot very broadly in the firm because we want people to use the tool, then they will start to come up with the next idea. When the iPhone came out, we said, oh, this is cool. It's a phone, a media, a flashlight, a camera. But what Apple was doing was they were unleashing the innovation of people. That is what AI is going to do, and we won't see it, and for a little while. Today, from an investment standpoint, it's all the picks and shovels. It's the NVIDIAs and the cloud services. But the real investment opportunity is understanding which firms in each sector actually start to make it be a differentiator, and it'll be very hard for the others in that sector to catch up. And so I think, part of the investment process is ask, well, what are you doing? Now, we have a strategic partnership with Microsoft that we announced, where Microsoft actually made us a strategic partner because some of the things that we had laid out, they said, are really challenging from a technical standpoint, and they wanted to be involved. They're actually providing us resources to build it.
How do you think about trade and tariffs? So Donald Trump will be inaugurated January 20th. I mean, are you expecting more deregulation? What does it mean for asset managers, or is it inflationary because of the specter of tariffs?
Well, so on the tariff front, I always say, remember, Trump is he's a deal maker, right? So if you're the deal maker, the first thing you want to do is express your position of power. So the greatest way to express that is say, I'm going to do all these trade tariffs on all these countries, and then you start there, and then you negotiate what you want. So you think about it and say, well, what does he want? In the case of Mexico, he'd like help on immigration. Actually, he probably really does want to reduce the amount of FDI investment from China. That's increased, I think in 2018, it was like 270 million. Now it's just under 6 billion. So he'll probably want some help there as they're reshuffling their supply chain. Europe, he'd probably like some help from a military investment. He'd probably like some help on the attacks on some of the big tech companies. So he'll use that as his negotiation. Now, there are going to be tariffs. And with China, I think it's just going to be tough. But remember, China has just responded with now saying they're not going to export a bunch of minerals that are critical to the U.S. Right? We have to remember, the U.S. needs China and China needs the U.S. So there has to be a reasonable approach on both sides. And I think that will happen over time. But tariffs tend to be inflationary.
Do you worry about emerging markets? You're very embedded in a lot of the emerging markets that could be the biggest losers in this.
Yeah, they can't. I mean, they've been pretty savvy. You figure out places where there's growth opportunity. One, either the China plus one supply chain. I know that Trump has said that he's going to go after and try to reduce some of that. But that's very real, and it's helping different markets. You can look at some, take in India. Look at India's going to grow just from domestic. If they could just get their domestic economy continue to go, it's going to be a great opportunity. 56% of the population under the age of 25. So, you have to pick your markets. We like Korea, Thailand in certain sectors. The consumer in Thailand we think is a good opportunity. So, it just depends, and you have to figure those out. That's why I like active investing.
Oh, there you go. Always a pitch. What about deregulation? Is it going to be good for?
I think he's expressed. I mean, it's only the last time we saw a president that was already in power was Grover Cleveland. So Trump's been in power. We've seen what he's done. He has said that he wants less regulation. He did that his first term. So I think we would expect to see that. And I think that tends to be good for businesses.
Good for equities. You have a lot of fixed income. I mean, there's talk about independence of the Fed, which he's now walked back on.
Well, it's interesting because if you actually do a bottoms-up earnings projection for next year on the S&P 500, it's like 14.5. It's slightly higher than that. So these are companies who are projecting their earnings being up, right? So they're looking at a lot of the tailwinds that are going on in the U.S. economy. Whether they're overzealous about what interest rates will ultimately do, who knows? But, I think that it seems to be very positive for equities. And I think the good story in 2024 is that the equity markets broadened out as far as the returns.
So what's the best way? If I gave you $3 million, how'd you deploy those $3 million?
Well, if you could afford the illiquidity risk, okay? So I'm just going to tell you two that I love right now. One is secondaries, just again, because you had $6 trillion deployed in private equity, and you've had about $150 billion deployed in secondaries and maybe another $150 billion raised. And we thought that it would dry up once the equity markets came. But the reality is, when the IPO market has slowed down, people need liquidity. And so they're going to secondary managers, and the returns, we're seeing some of the best discounts that we've seen in the history of it. And the second one is actually real estate debt. And here's why. Most of the regional banks were the big lenders in the real estate market. And the reality is the office, if you're not a grade A office, I think a lot of the real estate people would say, we're still not sure we've seen the bottom yet.
Right.
But what you see a lot of the bankers saying is, hey, don't hand me the keys back. I'll give you a good term rolling it forward. But that means that they're not lending to the new developers out there. And so we're seeing that there is a real opportunity. So Benefit Street Partners, our private credit manager, actually has about $9 billion in real estate debt. They were having conversations with Clarion Partners, our real estate team, real estate managers, saying, hey, if we end up taking over any of these properties, we'd love to talk to you about how to think about monetizing it and maximizing return. And in it, they identified that there's this real opportunity because as these regional banks have stepped back, you can't just be a private credit manager and say, oh, today I'm a real estate expert. You actually have to have that expertise. So we think that's another really interesting. So those are two I'd say go for.
And Jenny, in terms of interest rates, are we higher for longer, given all of the uncertainty out there?
I'd say with the U.S. deficit, I don't see how in the debt. I don't see how that you can't. You obviously have, pretty robust economy, all those things. I mean, but I think most people think the Fed will cut. In December, I think it's something like the 87% likelihood or something. Projected.
But afterwards, it's tepid.
Maybe two more. But then I don't think I think it's higher for longer. And again, I think people are underestimating the risk of, or not the risk, because the U.S. is still going to be the reserve currency, and you're still going to be able to always finance it because there doesn't seem to be another, option. But at what price does it crowd out other investments? I don't think that's a 2025 problem, maybe not even a 2026 problem. But at some point, this becomes an issue.
But this is what, a diversification away from U.S. dollar reserves?
Well, I like I said, I don't think it's a 2025 or a 2026 problem. So I think it's somewhere further down the road. Okay. But I do think it keeps rates up a little bit.
Final question, what's your priority for 2025?
I think we did these 10 acquisitions, and now it's about digesting and finding opportunities. Like this real estate credit example, came because two CIOs were having a conversation just to try to gain some insights from each other, and they're like, we see this dislocation in the market. Like one of the key things that we do is twice a year, we bring all our CIOs together, both from public and private side, to just get to know each other. I always say the dinner's more important than any topic, because as they get to know each other and they get curious and they're comfortable asking questions. I mean, it was really fun to be sitting there watching the value guy and the growth guy debate the valuation of NVIDIA, in their core. I always think one's a pessimist and one's an optimist, but in their core, their view on what that is, that makes for healthier investment teams to have that kind of access. And we can provide that 360 view of capital markets to all our investment teams, which I don't think you get in most other firms.
I'm tempted to ask about NVIDIA, but that's our next panel. Jenny, thank you so much.
Thank you.
Jenny Johnson.
That was Francine Lacqua, of course, speaking to Jenny Johnson, President and CEO at Franklin Templeton. I'm Anna Edwards. We are live on Bloomberg TV and on Bloomberg Radio at Bloomberg's Women, Money and Power event. Welcome to the programme. We're keeping across all of the events that are happening on the main stage here at this event. Terminal subscribers can also follow along if they wish to. TLIV is the function to use to find the TLive blog. So there you'll find our journalists keeping track of all the conversations that are taking place and bringing you any headlines from them. You can also join us virtually at Bloomberg.com and on the Bloomberg Live channel on YouTube. And looking ahead, I'll be hosting a live Q&A about the event, about some of the headlines coming through from the event. A lot of talk about M&A here. We will be joined by a crypto in-house expert. We will also talk about the finance industry. We just heard from Jenny Johnson there about many aspects of finance. We'll put all of that under the microscope. 1 o'clock London time for that Q&A event. You can find that on the Bloomberg terminal and indeed on the Bloomberg website. Now, Citigroup CEO Jane Fraser is entering the final stages of her efforts to simplify and streamline the American bank. But investors remain tepid, with the stock lagging behind peers and analysts predicting she'll miss her 2026 profitability goal. Fraser spoke exclusively to Bloomberg's Shanali Basak ahead of the Women, Money and Power event.
Jane Fraser is the CEO of Citi, and she's reshaping the bank. It is one of the most transformational changes to U.S. banking in a generation, and she has a unique perspective of challenges and opportunities ahead as the leader of the most global U.S. bank. Jane and I sat down at Citigroup's New York headquarters on November 12th, and this is part of our conversation.
Given the world is changing so quickly, where is the most promise over the next 5 years? And what regions of the world do you see as lagging?
Well, I always like to talk about bright spots first. So I think the bright spots is America. If you talk about a lot of roads leading here, fantastic entrepreneurship. I mean, this country is incredible. I love how Japan is turning up, focused on returns, moving from savings to investment. Entrepreneurs also on the front foot there. So that's exciting. Most of ASEAN as well, really adapting and adopting a lot of new technologies. The Middle East is a different Middle East. As a woman, I find it really exciting to go there and see how quickly it has changed, and the female population is being unleashed in many of these countries in a very positive way. And I wouldn't forget Brazil and Mexico as areas where we're also seeing tremendous innovation. So I think those are, that's a pretty broad group of winners there. Europe has a tougher time. They've got some more structural challenges. Labour market is not as flexible. They don't have the scale that the States has. And they've got some challenges in terms of competitiveness. So that would be a quick walk around the world of the highs.
While the world is changing, so too is the world of finance.
Yes.
In particular, you've seen for many years now the banks cede some share to the non-banks, and you made a lot of news this year when you struck a partnership with Apollo, a $25 billion partnership in order to provide more private credit to your clients. Where do you see the private markets going at the end of the day?
Look, when you look at a transaction and a partnership like the one we have with Apollo, you're looking at a win-win. And as we look at it, we're marrying our strength in origination and some of their power on their balance sheet in areas that we can't compete with them on, and put it together in 1 + 1 = 3 for our clients, because we're still giving our clients choice. And I think that's what we see the private market as. In non-investment grade clients in particular, and companies, it's giving them an additional market to tap into. Some points, the private and public market, there's no arbitration between the two. Last couple of years, you saw the private market advantaged. The goal here from our perspective, give the client as much choice as possible. Again, what does it mean? I come back to America as a proud immigrant. What you see here is the depth and breadth of capital market. We have 50% of the world's capital market. We keep innovating. The scale and specialization it affords is really tremendous. You just don't see that as much in the rest of the world. And that, I think it means, why does the US keep being the winner in the global financial and capital markets? It is because it deserves to be.
At that end, too, what is the biggest risk to the industry over the next 5 years? Where do you have to look around the corner the most?
The piece that keeps me up at night is always cyber risk. And I think when we think about fraud, AI, and cyber, and the sort of convergence of those capabilities, and the speed with which activity can be done now, and that compute is going, that definitely continues to keep me awake at night the most. So I think that is the larger threat. At the end of the day, this industry is about trust. And so I think all of the larger institutions are putting a lot of resources to make sure that we can protect our institutions and our clients.
Jane, where do you see Citigroup in 5 years? You have embarked on this massive transformation. What is your greatest ambition?
Oh, well, my ambition is to be a high-returning, high-quality earnings, modern, simpler institution that continues to play a shaping role in the global financial system. We're truly privileged to be in as many locations as we are, with a talent base with such a global mindset and an ambition about it. So I think about we've got the right strategy and vision, we're executing with the right organization, and that we're a simpler, well-controlled, modern organization. We'll have got the job done.
Our exclusive interview there with the Citigroup CEO, Jane Fraser, speaking to my colleague, Shonali Basek. Now, Bloomberg's Chief Content Officer, Heather Harris, is busy moderating, just getting underway with a panel on private credits, the private credit industry here at the Bloomberg Women, Money and Power event. So let's listen into that.
I'm told if you have any questions for our panel, please remember the QR code is there and we'll be able to see them here and hopefully squeeze some of them in as we go along. So as Jenny mentioned, one of the trends we've seen obviously is private equity held companies staying private for longer. We've also seen the ascent of private credit reaching ever new heights. We're seeing deals between banks and private credit firms. So a lot to unpack in this session. So Anne, I'd like to start with you, please. You've obviously seen the entire evolution of private credit sitting in your perch as Chief Investment Officer at Guggenheim Investment Management. Can you talk a little bit about where you think we are in the cycle of private credit right now? So obviously we've had a big boom since the GFC. We're now hitting, I think by last account is $1.7 trillion in private credit. Where do you think we are heading into 2025? How's the market responding to the higher rates that we've seen, and where do you see the biggest opportunities for investors now in this market?
So thank you very much for having me and us as a panel. Let's start with sort of the backdrop where we are. So about 7 to 10 years ago, we saw a real shift in capital markets in the U.S., where we've really moved away from a public market paradigm, which we had historically. We're down to approximately 3,500 or 3,600 listed companies in the U.S. relative to private equity-owned companies, which are about 5,500. And as I said, that sort of crossover occurred nearly a decade ago. And ever since then, we've been on this sort of a trajectory and evolution with regard to more private investment that's been going on. In particular, when you have private equity-owned companies, they're not necessarily going to want to access public markets. They're not going to want to be able to have that or be required to have those kinds of disclosures. And they're going to go to private capital providers. And so that's why we've seen this evolution of an increase in private credit. And if you look at the markets, if you look at particularly non-investment grade space or leverage space, the public high yield market has declined in size relative to the private capital markets as well, and private credit. So we've had this sea change in capital markets. And along with that, we've had global central banks, particularly post-COVID, let's go all the way back to the financial crisis, but even more recently, who have pushed a huge amount of capital and liquidity into the system. If you get a sense of it, post-COVID, about $12 trillion globally came into the global capital markets. Some of that has been removed by central banks as they've migrated towards quantitative tightening and trying to battle inflation. But there's still a whole lot of excess. Only about half of that has actually come out of the system. And so even adjusting for GDP growth, we probably still have $3 or $4 trillion that's left sloshing around, providing this excess liquidity, which I think really supports the private capital markets, not just in the US, of course, but also globally at this point in time. So I think fundamentally, we're in a pretty good place for private credit, and I think this growth and evolution will continue. And I think the trajectory, I've seen estimates of potentially $4 trillion in private credit going forward relative to where we are now. So we could see a doubling of the size. And I think one of the elements that would potentially drive that is a way for retail investors to somehow move into private credit, which right now that's really not happening. It's at the very beginning in some cases, but that will also drive that development and make it more, shall we say, the democratization, if you will, of private capital.
Thank you. So Danielle, I'd like to come to you next. I think you've seen about 10 years of private credit evolution at Oaktree. Can you talk a little bit about, what surprised you the most about what we've seen this year in trends in private credit? And then secondly, what has the US election result done to the market? How has that changed your assumptions heading into 2025?
Of course, and thank you again for having all of us here. You know, I think one of the biggest trends really has been the convergence between private and public credit. And, sometimes they're pitted against each other as rivals. And the dramatic growth that we've seen in private credit over the last 10 years, really more just in the last 4 or 5 years, is often, described as taking away opportunity from the public markets. But I think that the combination of the two, they've really started to exist more symbiotically, and it's actually helped borrowers in the overall health of the financial system this past year. And so what I mean by that is if we look back at 2022 in particular, back then banks were hung with loans, the public markets were a little spooked with volatility, and private lenders stepped in really to provide a lifeline and stabilize public credit companies. Flash forward to this year, 2024, and we've seen public markets be more comfortable with the economic environment for rates, and we've seen their financings boom. So this year in particular, we've seen a number of deals move away from the private market into the syndicated market. Actually, 20 billion of deals that were refinanced in 2022 deals, 20 billion of those this year have actually been refinanced into public markets, which is significant. There's always going to be certain companies that need to be in the private market because of their size or needing nuanced financial solutions. And we're starting to see hybrid solutions be announced. So earlier this year, Ardana, did a public-private hybrid where, 5 billion and 2 of that in high yield and 3 in private credit. And so I think they're keeping their financing options open. So where does it, go from now? With Trump, he did run on a lot of pro-business policies, and in particular deregulation and corporate tax cuts. And on the deregulation front, we're optimistic that that should lead to more M&A activity. And that would be, good from a financing perspective. And then also with the tax cuts, it should boost profitability of the companies that we're lending to at the same time that rates are potentially falling. And this creates, I think, a really attractive time to be a credit investor.
So more boom times into 2025 then. Yeah. So one thing you mentioned, obviously, is the banks and regulation. So Alison, I'd like to bring you in here, as obviously you spent most of your career in commercial banking, including since in leveraged finance. So one thing that's really defined 2024 has been all these tie-ups that we've seen between banks and private credit firms and how that plays in to everything that's going on in the markets. And so is it you can't beat them, you join them, the kind of, uncomfortable frenemies relationship that we're seeing? Jane Fraser referenced it in her interview. It's, she calls it a win-win-win. If you're a bank, how are you feeling about this, and what are you getting out of it on the ground floor?
So I think it depends of which lens of the telescope you're looking at.
Right.
So I think from a client perspective, the innovation and growth in the private credit market is fantastic because there's more choice, there's different pools of capital, and it means you're less tied to the opening and closing of the public markets, and there's more access. So I think that's a huge positive. Clearly the banks are catching up a little bit on this as more regulation post-financial crisis has gone into the banks at the start of the value chain. You've seen, less of their balance sheet being used for leveraged loans, and that was the first kind of real move in private credit. It's now moving into corporate and investment grade and moving into the traditional balance sheet. I think depending on what type of bank you are, it is a win-win situation because with the constraints on balance sheets, the regulatory restrictions, the cost of capital, it gives you...
We will duck out of that conversation there. Bloomberg's Heather Harris in conversation with Danielle Pauly of Oaktree, Alison Rose, who was just speaking there, of Charterhouse, and Anne Walsh of Guggenheim. Much more to come from the Women, Money and Power event here on Bloomberg TV and on Bloomberg Radio. Later on today at this event, we'll be hearing from the Man Group CEO Robin Grew, the Executive Chair of Santander, Anna Botín, also among many other voices. Have a good day, everybody. This is Bloomberg.